Hi, good morning all. Thank you for joining in on Saturday morning. So today I and my colleague Ashna have lined up with an interesting topic or webinar, which is where we would invest 1 crore in today's market. So here, I would give a quick disclaimer that we are not expecting like we are going to give you an allocation plan on where to invest, when to invest, and so on. But it's more about what asset allocation, what financial goals, and risk capacity plays a major role in this entire exercise. So for last 6 months, as you all know, that markets have been anything but not predictable. So this is a time where markets are volatile, other themes are attractive. We need to do a review and see it's like what rebalancing is needed so that you are working towards your goal. So hence in this webinar, we'll walk you through on what we would actually do in this market environment and make through that we balance the risk and long-term wealth creation is on track. So whether you're sitting on idle cash, planning a fresh investment, or simply want to understand how our portfolio allocation works in this current market, this session will give some insights on the same. So we are looking forward to have an interactive session. Once the presentation is done, last we'll have a Q&A session where whatever doubts and queries that you have, we'll be answering the same. So I'll pass it on to my colleague Ashna. Yeah.
Good morning, everyone. Thank you, Vinayak. We can get started with the webinar. So firstly, before we cut to the chase, there are a few important aspects that we would like to highlight with respect to where we are in the markets, how the markets have been over the years, what is the strategy that looks to work in the current markets, and basically to just trudge our way through the current markets first, understand where we are, and then go about what are the opportunities that the market is currently throwing at us, right? So to begin with, we have basically classified the market cycles across 3 phases. The first phase we can say is euphoria, when everyone is buying and narratives are dominating. This might be the phase where return expectations need to be more on the cautious side because valuations are often at the fundamentals, which is why it's called euphoria, right? So we can say that parts of the small and mid cap market recently looked like euphoria or looked euphoric. The second phase, which is something that we are currently at or closer to where we are, is divergence, where FIIs were selling and domestic flows remained resilient. So markets were internally divided. So the important question here is not whether coming in, but where is it going and where valuations still justify the same, right? The next phase is opportunity, when when panic becomes widespread and the threats become genuinely attractive and expectations are extremely low. So those phases rarely feel comfortable in real time, but they create some of the best long-term entry points. So the key takeaway here is that corrections alone do not create opportunity, valuations do. And patience in markets like these is not inactivity, it is you positioning or rebalancing your current portfolio for the next phase, right? That said, we can now go to probably see how the markets have been over the past few years, because people who've entered the markets, let's say in 2020, have only seen one part of the markets, right? So it was basically one asset class that rewarded, and people, so this experience over 5 years, it creates a very specific kind of investor psychology, that this is how markets work, because people who entered in 2020, as I said, have seen just one side of the markets, right? But 2025 was different, and so is 2026. So how is it that we position ourselves through these markets, right? Since 2028, they've been one way up, and all of a sudden they've become sideways. So what works best in such markets is asset allocation. So of course, it might not look clever when everything is going up, but when the tide is high, every boat floats. So it's only when the tide goes out that you see who is positioned sensibly and who was just riding on momentum. So asset allocation is comes in as utmost important behavior in these markets. How does it work for you? It basically acknowledges the fact that pure equity investing ignores. So no single asset class can win every year. So going forward, we will have data or a chart on how no single asset class has performed more than 2 years and how people tend to just chase the past winners, right? So cycles rotate, leadership rotates, and we've been seeing that, right? So this is so asset allocation is the way through this where it will actually protect you from the kind of markets that we are in, and at the same time, you will be positioning yourself towards long-term wealth creation. Coming to the next slide, this might actually be the most important slide because it taps into investor behavior. And if any one of this is something that you resonate with, it's actually time for you to rebalance or relook into your portfolio, right? So whatever be the discussions outside with on the macros, on the valuations, on the market cycles, stock specific, everything becomes meaningless if the investor behavior is working against it, right? So first things first, timing the market. So people wait for the perfect entry point, meaning, whenever there's clarity, I'll enter, or whenever so and so event happens, I'll enter. So the problem is not just that timing is difficult, but it's that missing recovery part that actually hurts your returns. So you keep waiting for the perfect entry and you end up missing the recoveries, right? The second part is chasing narratives, which is something that currently we've been dominated with. So many people maybe many opportunities may be long-term ones, but once a narrative becomes popular, maybe after a sharp rally, what investors do is they often end up paying for the excitement rather than the value. So investment stories are not the same as investment strategy. And irrespective of where the markets are, you need to ensure that your portfolio is aligned with your goals and your thought process, right? The next thing, something which is in line with the previous one itself, is performance chasing, which is another common trap that investors fall into. So they naturally move towards what has worked recently. A quick example might be gold. After gold performed, people had FOMO and they started considering, taking some exposure to it. But, in markets, yesterday's winners often become tomorrow's disappointments if valuations run too far ahead. And that's what we have been seeing, right? The next thing is emotional selling, which is also equally damaging. So corrections might create discomfort. In fact, that is what it is for, to create discomfort. And that discomfort often creates the urge to do something about your portfolio, or to show some activity on the portfolio. But if we end up doing that or being a trap of it, we are just skewing our portfolio towards something very meaningless, right? So that is also, emotional selling is also something that investors often fall trap to, and something that we really need to avoid, right? Next thing is something that I've already emphasized in the previous two slides. It's ignoring allocation, because concentration often disguises itself as conviction. That, oh, concentration means I have conviction in just a couple of names. But there's a difference between believing in an idea and allowing one theme or asset class to dominate your financial future, right? So you need to have that balance, and you need to ensure that you are spread across the right kind of assets at the right point in time in the right position sizing, right? And finally, something which is similar to chasing narratives and performance chasing is reacting to headlines. We need to ensure that all of these short-term noises do not affect our long-term decisions. Uh, None of us can predict the markets. What happened yesterday might not happen tomorrow or the other way around. So we need to ensure that our portfolio is built for the long term and we do not fall trap to headlines or narratives. Right. Coming to the asset allocation part, which is specific to you. So we've mentioned that asset allocation is important and why it's important. Now, your asset allocation must actually reflect your life. It's not just about having exposure to certain asset classes at certain points in time. It should reflect your goals, your income stability, and your time horizon. What works for your friend might not work for you because you both do not live the same lives. So your emotional tolerance also matters, like your emotional tolerance for seeing your portfolio go down temporarily. That is also something that needs to be factored into this. So how is it that you decide what is the right asset allocation for you or the optimal asset allocation? Just probably ask yourself a couple of questions like, do you have liquidity needs coming up in the next few years? Answer that for yourself. Maybe your child's education or a home purchase or some planned expense, right? So if yes, that money should not be in equity because the goal is short term. Secondly, maybe ask yourself, what is your income situation? So if your income is stable and predictable, you can probably afford more volatility in your portfolio. You may need more stability in your investment portfolio if your income is fluctuating, right? So this is also something that you can ask yourself. Maybe you should also ask yourself, how much volatility can you actually tolerate, right? Not what you think you can tolerate when markets are fine, but what you've kind of historically done when markets fell sharply. So what is the amount of drawdown that you can actually take, right? So a couple of these questions are things you can ask yourself to decide what is the asset allocation that's optimal for you. So coming to, the asset classes, equity remains your growth engine, and it is definitely for the long term and for wealth creation. And it requires tolerance, risk tolerance as well, right? Debt comes in as your stability layer and probably for your short-term goals as well, right? That's its nature. Gold usually acts as a crisis hedge. However, it behaved differently over this particular crisis. So gold is something that at this point you need to be very, very, very cautious of and probably take exposure to it only if you have the need to, have gold, not probably immediately from an investment perspective. Lastly, cash is something which is obviously liquid. So you need to probably have some amount of emergency fund and also to invest, like cash liquidity to invest in the market, in these markets as and when they go down. Right. So this is a quick brief on how asset allocation is personal and how you can determine what you think might be the optimal one for you. Right. So as I said previously that I will be presenting a chart where it shows how each asset class has performed over the years. And if you notice, we've seen that no asset class has been able to perform for more than 2 years in a row. So this is something that all of us need to understand and unlearn, that basically chasing what has already performed or entering into yesterday's winners is not the optimal strategy, because we need to think ahead. We need to position our portfolios from a 5-year perspective from now. So this is how we need to go about asset allocation. All right, so cutting to the chase, after we've discussed asset allocation, the mistakes investors make, how it costs you, how you can basically determine your ideal asset allocation. This is the slide that is something which we've all been waiting for. Basically, where to invest in 2026, right? First things first, this is not a model portfolio, or it is not an advice that you can replicate mechanically, but it's just views on asset classes and how you can position yourself, right? So large cap is something that we're absolutely constructive on. After the correction we've seen, large cap valuations have come closer to their long-term averages and at historical lows, particularly in certain sectors, right? So the improvement in risk reward is quite meaningful in this space. Mid and small cap is something that we're selective on. They're not they're not uniformly attractive, like how large caps are, but there are very specific and bottom up good quality opportunities within the space. But as a broad category, but the broad category as a momentum driven allocation right now carries real risks with respect to mid and small cap. So basically, the next thing we have is debt, short duration and long duration. Something that, again, we are a little cautious on because of the ongoing geopolitical situation where every day is a new day. We just feel that equities offer a better risk reward scenario, and in comparison to the same, we can probably take long-term exposure into equity. However, short-term debt might be something that you can probably resort to. So the rising yields might benefit new entry. Coming to gold and silver, as I already mentioned in the previous slide, something that we are quite cautious and selective on gold, and as and when markets, let's say, provide certain opportunities or unfold opportunities onto silver, we might also take exposure into the same. However, something that, again, we need to be cautious about, because this asset class performed exceedingly well last year. Coming to international equity, of course, geographic diversification makes sense over 10-15 year horizons. It provides the earning streams driven by factors independent of India's domestic cycle. So, of course, that logic is sound, but maybe buying Nasdaq or S&P 500 at 25-40x multiples today is not a diversification decision. It's a momentum decision. So we keep getting queries on international markets and how can we hedge the rupee depreciation, right? So all of that was something that we were getting while we were in the war. Right now, maybe might not be, India might be the place that we all need to resort to. So the smarter approach to international equity is probably finding specific businesses with strong fundamentals and not something which is driven by momentum. Cash, again, as I said, is a liquid asset and something that you can hold on to for further investments and for your emergency purposes. That said, maybe I can, coming to the last few slides, the crisis we right now, as we speak, might be fading. So the direction has changed. Oil has corrected, freight is normalizing, rupee has also stabilized to an extent, and the government and RBI are both moving in consensus. So this is making India more attractive to global capital, right? So the macro damage of March through May will probably not be undone overnight, right? The recovery will take time, but the direction has changed, and that matters enormously. So that said, how is it that you position portfolios? Equities, as I said, will be saying again, particularly the blue chip companies that bore the brunt of FII selling previously are now at valuations that have historically been excellent entry points, right? So it's not like the businesses behind it have weakened, but it was just the sentiment because of which they had to bear the brunt, right? Uh, Next is basically the investment behavior, which we've already spoken of, which is the biggest risk right now. So you need to unlearn a lot of narratives in order to position yourself in the markets that we're currently in. Domestic participation remains structurally strong as it should. And let's say, we have basically, the DIIs have basically shown resilience to the markets that we're currently in. So this is a quick brief on how the crisis has been fading and what to do next. This is a quick chart of a quick data on how markets kind of outperformed after the years of crisis, right? So what you're looking at here are different instances over the past 2 decades. Let's say where an investor entered the market of at the end of the calendar year and simply stayed invested. What is the returns that they're getting, right? So let's say you can say for almost after every year, almost every other entry point delivered a healthy double-digit annualized returns itself over the 2 years, right? So this is a quick data point that gives you confidence on why you need to put money in these current sideways markets, which will basically reward you in the long term. So if you have a long-term perspective towards investing in wealth building, this is the data that you need to resort to in order to make up your mind and go all into investments. So what I showed previously was quick data on how markets performed after crisis. So now let me talk about something that I think is more important than any market call, right? So we have already spoken of how an investor needs to behave in the market cycles. And here is what a typical market cycle looks like from inside. So this is something that you can take as a cycle, right? So in years 1 and 2, first and second year, maybe no meaningful returns. Portfolios move sideways, patience gets tested, and maybe you also get carried away by what your friend is doing, what your neighbor is doing, right? Then let's say in years 3 and 4, this still continues. The market is still quiet. The temptation to exit reaches its peak. The temptation to have some activity in the portfolio is constantly there. And you tend to move to, let's say, safer alternatives, right? After that, later, somewhere in year 4 or 5, things begin to shift. Returns start to emerge. The 6th year is good. The 7th is even better. But the investors who surrendered in year 2 or 3 do not capture any of this that they have had in year 6 and 7. So what I'm trying to say is markets will move in cycles and equity returns are lumpy. There might be 3 years or 4 years of underperformance, but the outperformance post that is going to be so substantial that it might as well make up for the years where it didn't perform. So the key takeaway here is not to lose patience, have a long-term vision, and continue your investments as per your financial plan, as per your goals, in line with what you want to achieve with your own money in the future, right? So now to wind up the session and to wrap it up completely, We have spoken of asset allocation, investor behavior. What are the spaces that we feel you need to be positioned right now? What are the spaces to avoid? How to tackle the current crisis that looks to fade? How is it that we implement all of this? So the first thing is to avoid extremes. We should never try to perfectly time the markets with maybe one large deployment, but what we need to ensure is we are resorting to this SIP or STP strategy where uh, in phased out period, our investments are phased out into period so that our costs are also averaged down. So instead, you should not be timing the market. You should be staggering your investments such that you can make use of the volatility. Long-term SIPs should generally continue through the volatility as said, right? Rebalancing is equally important, but it should not be a constant tinkering, right? If allocations are drifting meaningfully from your intended range, or if, let's say, something has moved so much that it is not in line with your plan or your financial goals, that's when you will have to rebalance. So you can have something in mind that maybe every 3 years I'll rebalance, or as and when something in my life, so there are some changes in my life, that's when I will look to rebalance the portfolio. So you can have such time frames in mind for you to rebalance the same, right? So liquidity also matters. Liquidity strategy, cash is also an asset that you need to have so that you can keep participating whatever opportunity these sideways markets are throwing at you. And finally, avoid an all-in, all-out decision, right? Extreme positioning in these markets come from emotions. So that is not something that we can let take over. And most importantly, review your portfolio when something meaningful changes, as we said, that there's some change in your life or some deviation from the allocation. It is always important to review your portfolio, right? That said, I come to the end of the webinar.
Thank you all for joining for today's session. It was a, let's say, a good, insightful session, I believe. And if you guys also have some direct queries or something related to personal finance that you would like us to talk about, you can always get in touch with us, our team. So I've dropped in Ashna's number and mail ID also in the chat box. So after the meeting, she'll also be getting in touch and connecting with you. And we look forward to catching up and let's say doing more sessions like this again. Thank you.
Thank you, everyone. Bye.